I'd like to frame it from the standpoint of the importance of the U.S. election for Asian equities overall, and the view that we've had, and this really was prior to the debate, but really sort of a continuing one here, is that there's likely to be an increase in volatility in the run-up to the election, for the following simple logic: that our global markets analysts have done some work looking at the four key scenarios for the outcome for the U.S. election. That would be either Biden or Trump, and then obviously whether it's a divided or a sweep, divided government or a sweep. And the key point is that under those four different potential outcomes, there's likely to be quite significantly different asset price response in the U.S. to those outcomes, for when you think about potentially different fiscal policies, not monetary policy, but fiscal policies, layering on tariffs under a potential Trump presidency, and then the effectiveness of Congress in passing that, depending upon whether it's divided or a split government. The point of that is that if we think that there might be significantly different reaction by the dollar, by the S&P, and by bond yields, then that's going to have a significantly different impact on Asian markets. And given that it's still a close contest, then the market's likely to price that uncertainty going into the election. So one of our key views has been, we think July starts off well for Asian markets. Typically, it's a good market seasonally. And also, we've got a number of catalysts, whether it's the China third plenum, whether we've got the Indian budget, et cetera. But then I think the months of August, September, October are likely to be choppy to down, given that uncertainty.
As we get closer to November?
Correct, yes.
Yeah, okay. So the four scenarios, right? You got to admit that post the debate, things are leaning more towards the option that says Trump 2.0 and divided government. In that case, what happens with equities, with dollar, with yields?
Well, the prediction markets have leaned in that direction, as you said, and our continuing view is that one of the most likely outcomes of a potential Trump presidency would be a stronger dollar. We think it might be incrementally beneficial for the stock market, but the opposite of that would be bond yields might go up as well. So we've got stronger dollar and higher bond yields, maybe buffered by a better S&P. That's something which might be, somewhat challenging for Asian markets in terms of their initial reaction.
I was going to say, right, but I mean, having looked back at his the first time he was in the Oval Office, if I'm not mistaken, during that tenure, dollar was down during his term, and the sense is that this is a guy who wants to drive U.S. manufacturing in, would be fine with a weaker, more competitive dollar. No?
Perhaps yes, although I think we need to be careful about mapping the first reaction of the market during the first year of his presidency versus now. The analogs may not entirely run. But I think the key point here is that if you've got potential further stimulus to the U.S. economy through making tax cuts permanent, for example, then that is one of the core reasons why we think the U.S. market might trade up, but that also would tend to be better for the dollar. I think the other thing to remember is that the current environment is a different one than it was for the dollar 8 years ago. And I think the key point to note here is that a number of the majors have already started cutting. You've had Canada, you've had Sweden, you've had the ECB, BOE may go. So you've already had a wide interest rate differential. That's extended somewhat because the other DMs have moved first. So even if the Fed does start to move, as we think it will do in September, that would just sort of bring the widened spread back to where it was previously. So there still is a very favorable funding spread in favor of the dollar. And so unless the Fed really gets into much more concerted easing and brings that spread between U.S. rates versus other competitive rates elsewhere, either DM or EM, it seems that the dollar in the near term will be stronger for longer.